Hello, everyone. It's Shayna Fossum, Financial Advisor here at Security First Asset Management with your weekly market update. A couple of quick announcements. We'll be having our fourth quarter drawing for that $100 Visa gift card next week in our weekly market update, so look for that in your inbox. If you've referred a friend to one of our events, you'll be entered into that drawing. This holiday season, we are donating items to the Rescue Mission of Middle Georgia. They are in dire need of gloves, hats, socks, and blankets. If you would like to donate any of those items, you can bring them by any one of our offices over the next couple of weeks. Last week, domestic stocks gave back much of the previous 2 weeks' gains, as some surprisingly strong economic data dampened the hopes that the Federal Reserve might slow down their raising of rates to cool inflation. The S&P 500 recorded its worst return in 5 weeks, while the Russell 2000 endured its worst week since late September. Within the S&P 500, the typically defensive healthcare, consumer staples, and utility sectors fared the best, while energy, communications, and financials fared poorly, in part to the negative economic outlook given by several banks. Shares in Europe fell on renewed fears of recession as their central banks tightened their monetary policy to help quell their inflation. Wholesale prices rose more than expected in November as food prices have surged. The Producer Price Index, which is a measure of what companies get for their products in the pipeline, increased 0.3% for the month and 7.4% from a year ago. The more widely watched Consumer Price Index data for November will come out Tuesday, just tomorrow, just a day before their Fed makes their announcement of their interest rate hikes. Households have increased their debt at the fastest pace in 15 years due to hefty increases in credit card usage and mortgage balances. It is the largest annual jump in more than 20 years. In addition, in October, the U.S. savings rate fell to 2.3%. It is the second lowest savings rate on record going back to 1959. U.S. unemployment filings rose slightly last week but remained historically low, a sign that the labor market still remains tight despite layoffs at some companies and broader economic uncertainty. Gas prices have eased slightly, and the home sales have plunged due to surging housing prices. We are facing at least potentially the most widely forecast recession in history, as most economists think there is at least a 63% chance of a recession in the next year. The Federal Reserve is all but guaranteed to announce that they will once again raise their rates this Wednesday, but investors are hopeful that it will be a smaller increase than the last 4 hikes. Now, here's a fun little tidbit for you. I don't know if you guys have ever heard of this, but it's called the Christmas Price Index. It's a kind of a tongue-in-cheek economic indicator that has been maintained by the U.S. bank PNC Wealth Management, and it tracks the cost of items in the Christmas Carol, the 12 Days of Christmas. The first day of Christmas, my first tulip gave to me, a partridge and a pear tree, all the stuff they give. So even though it's a small sample size of 12 items versus the 80,000 that makes up the Consumer Price Index, this year's PNC Christmas Price Index rose up about 10.5% year over year, which is not far off from our current CPI. Have fun. I hope you have a great holiday and talk to you soon. Till next time. Bye.